The market has become a constant reminder that investing is risky. Are you getting the proper reward for the risk in your portfolio? Well, Ed Butowsky, managing partner with Chapwood Capital Investment Management, has some thoughts on how you can measure it. So just for your average Joe, you're trying to figure out, am I being adequately rewarded for the risk I'm taking? How should you look at that?
Well, first of all, thank you for having me on. And I'm happy to talk about this subject because I've been in this industry for 22 years. And the more I learn, the longer I go along in this business, I realize the portfolios that are being recommended by investment firms are not necessarily in the best interest of these clients. Now, it's not done in a malicious way. I think it's done because a lot of people just aren't educated on the basic ideas behind portfolio construction.
Now, you were a financial advisor at
Morgan Stanley.
And Morgan Stanley, so you've had quite a history of advising clients on how to look at their investments.
I manage quite a bit of money right now along with my partner, Chapwood Capital Investment Management. And what we really look for is how do we reduce risk in a portfolio, and is there a metric out there that helps us with that? Well, there is one. It's called the Sharpe ratio. Now, it's not just something that was made up one day. It won a Nobel Prize in 1990.
And this is something that institutional investors use all the time.
It's used all the time.
But when I say that, of course, I'm sure that people watching are going, great, institutions use it, how do I use it?
Well, it's very simple. And what is amazing to me is one day I gave a presentation to a group of President Club people from a very well-known investment firm. I asked them, raise your hand if you can tell me the Sharpe ratio in your portfolio. And do you know what, Margaret? Only 2 even knew what the Sharpe ratio was.
Okay, so tell us, what is it? How
Simply,
do you think about that?
A Sharpe ratio was invented or designed by a gentleman named William Sharpe, who won a Nobel Prize in 1990 in economics. It's very well known, called modern portfolio theory. The Sharpe ratio, you simply take your rate of return, subtract out your risk-free rate of return.
Which would be treasuries.
Exactly. Divided by your standard deviation.
And the standard deviation is how much your portfolio swings when the market swings.
That is right. And I don't understand why people aren't talking about this.
All right, so the idea is if you take a look at your return less the risk-free return, so that's what you're getting compensated for the risk you're taking, and how much your portfolio swings against the market, that number should be what?
You want to have a number that's above 1 if you can.
Okay.
And more importantly, anyone who's watching this right now should go back, call up their financial advisors and say, what is my Sharpe ratio? And if they can't give you an answer right away, without hesitation, you need to start looking for another financial advisor.
Okay, are there other questions that you should be asking your financial advisor to get at this risk-reward equation?
Yes, well, actually, something that we invented, which I'm looking forward to talking about, is called the Chapwood investment score. Because I looked at the Sharpe ratio and I thought, this is excellent for looking at risk return. But what it doesn't do is it doesn't take into account for rate of return, taxes, management fees, investment fees, your standard deviation, but most importantly, Margaret, inflation. If we're not beating inflation after everything's said and done, what are we doing? What are we taking these risks for if we're not beating inflation?
Okay, so what you're trying to do is create a ratio that for an individual investor takes into account their tax situation, rate of inflation, the fees they're paying to their advisor and on any funds that they're in.
Exactly.
And you're saying that, so what is adequate reward for that risk?
Well, I'll make it really simple. The term standard deviation is used quite often. An individual should be looking to have a portfolio whose rate of return is a certain number, but have the standard deviation be 60% or less than that rate of return. So if you have a targeted rate of return of, let's say, 10, you want your standard deviation to be 6 or lower. That means that, and I can go through this in detail, but what you're really looking for is find a way to have as little risk as possible. You would love to have a standard deviation or a volatility of 1.
All right, let's take this out of the realm of theory and into the market today, which is a pretty scary, risky place to be. So
yes,
I have a hard time imagining anybody getting that ratio into whack here. What do you recommend?
Well, in terms of, and I completely agree with you on that, right now it's a tough conversation, but people, when they're rebuilding their portfolios, should keep this in mind. It's not something that you shouldn't be thinking about.
Okay, and so what are, in terms of stocks, let's say, are there any stocks that you trust at this point where you think you're getting adequately rewarded for the risk you're taking?
Well, that's a good question. And what we do is we don't necessarily just buy the individual stocks. That we really have to, and this is what most people need to do, is compile everything into a portfolio, almost like baking a cake, and put everything into the mixing bowl, because one ingredient by itself isn't going to make it. You have to have other investments whose risks are different. But what do I like today? I absolutely love utility stocks. Okay, I think that is a
high dividend payers.
Exactly. Love utilities. I love blue chip stocks. Even after a day like today, we're going to have days like this, but we have to stop being so short-term focused and start looking a little longer term.
So blue chip IBM?
I would look at IBMs. I'd basically look at just about any of them except the financials.
Even with the tech news we were just talking about.
That's right.
Okay.
Well, you heard her. I mean, in the short run, anything could happen. Long run, I think everything's going to turn out to be absolutely fine.
All right, and beyond that, what about stocks versus bonds?
Right now, I would be probably the riskiest investment over the next 6 months is probably going to be U.S. Treasuries. They have been so overbought that they have very few places to go except down at this point. So I would be very nervous about buying into U.S. Treasuries at this level. I see your face, but that's exactly.
So the risk-free rate isn't so risk-free.
Well, not at all. If you buy a long-term government bond right now, you're probably over the next 6 months to a year going to lose money. That's probably the riskiest investment you can make as a standalone right now.
So should you be weighted overall more toward equities at this point?
No, I am.
Can you give me a ratio?
I'm genetically a bull, okay? And right now, Margaret, I find, even days like this, it's tough, and people have a hard time swallowing it, but you have to look 6 to 9, months out. I don't know why everyone's so short-term focused. Things are going to get better, and I'm very heavily overweighted into the equity side, but balanced.
All right. All right. Thank you so much, Ed. I appreciate your thoughts on that.
Thank you.
Our thanks to Ed Butowsky, managing partner with Chapwood Capital Investment Management, talking about risk reward. Well, when we come back, scandal rocks India. One of the country's largest IT companies admits to fraud. Who's to blame? What's the broader impact on Asian markets? Find out in 2 minutes on Taking Stock.